Okay, I see somebody jumped in. I just want to check if you can hear me okay.
Yes.
Okay, great. I'm going to go ahead and start. I'm not sure if anybody else is going to join. Before I start, do you have any questions?
No.
Okay, all right. I'm going to go ahead and get started. All right, so this is a quick review of the items that we're going to cover in the third exam, specifically chapter 7, 8, and 9. So there is actually quite a bit of knowledge, hopefully, that you will have picked up during the past 3-4 weeks doing the homework and completing the Edpuzzle assignment on these chapters. So just to jump right in, we're going to start off with chapter 7, which is chapter on fraud, internal control, and cash. If you recall, there was 4 learning objectives in chapter 7. First was what is fraud and what are the principles of internal control? We're talking about company. What safeguards does a company put into its operations to protect its assets? Assets include cash, inventory, equipment, etc. And specifically to cash, cash is of course a very vulnerable asset, easy to steal if it's not controlled. So we'll talk a little bit about what are the control principles revolving around cash. And then most companies today use a bank account to facilitate payments coming in from customers and payments going out to suppliers and employees. How does the bank account get controlled? And that's where we do a bank reconciliation. And then briefly, how does cash get reported? All right, so just quickly, what is fraud? Well, fraud is basically when an employee steals from the company. What kind of controls does a company have to make it difficult for employees to steal from their company? We call these internal controls. Basically designed to protect the assets of the company, ensure accuracy and reliability of the accounting records, even increase efficiency of operations, and lastly, ensure compliance with laws and regulations. So the principles of internal control, and by the way, internal control is a very important field in the world of business. And if you're interested in accounting as a major, you could actually pursue the field of auditing. Auditing is where you actually go into a company and check its internal controls. So what are the internal controls that a company employs to protect its assets? There's establishment of responsibility. That means control is always better when one person is responsible for a given task. For example, one person operating a specific cash register in a store. Internal control is always better when you have segregation of duties. That is, certain duties should be performed by different employees. For example, if somebody has actual physical custody of assets such as inventory, that person should not be responsible for the records keeping track of the inventory. Should be assigned to a different person. So you have what we call segregation of critical duties. One person handles cash, the other handles the accounting records. Normally, you would not want the person that's responsible for cash activities at a company also responsible for the accounting records. Now, that is normally the case in big, medium-sized companies, but in small companies where you have just a few employees, it may not be practical for a company to employ two people, one to handle cash and one to handle the accounting records. It's not uncommon for one person to be responsible for cash and the accounting records in a small company. So there's other ways you can protect the company when you have a situation where one person is responsible for both cash and the books. Okay, another example of internal control is documentation. Having good documentation procedures will help make it hard to steal from the company. For example, using pre-number identification like blank checks. Usually blank checks are pre-numbered, serially numbered, so that if there's any checks missing that haven't been used, it can be easily identified. So documentation procedures includes the register tapes, billing documents, shipping documents, blank checks. All right, the next type of control is physical controls. You know, a company that has inventory should have a way of securing that inventory. Warehouses that are locked up is an example of physical control. Having computer facilities that are password protected, alarms in warehouses. These are examples of physical controls. And then we have independent internal verification. That is, we always bring somebody in that is not part of the process to do an independent verification of the process. Usually, accounting records are verified periodically on a surprise basis by somebody that is independent of the process, and any discrepancies reported to management. So you have an accountant doing the books, and you have a cashier managing all the cash. The two are obviously linked, because whatever the cashier does with the money should ultimately be reported in the accounting records. That's why we have two people doing two different things here. The cashier doesn't touch the books, and the accounting person doesn't touch the cash. At some point in time, monthly or every quarter or every 6 months, you need to do an independent verification that everything ties together, and that is normally done by somebody other than the accountant and other than the cashier. For example, in this case, the assistant treasurer, who does the reconciliation between the two activities. All right, so lastly, we have human resources controls. So, you know, it's very important that people take vacations every year so that, you know, if somebody is like an accountant or somebody like the cashier takes a vacation, then that means somebody else has to come in and replace that person for a few weeks. That will make it difficult for the accountant or the cashier to commit fraud, because somebody will come in, might detect any fraud that's going on. So some examples of human resource controls include bonding certain critical employees who handle cash. That is, company will purchase an insurance policy on that employee in the event fraud is uncovered and money is stolen, lost. The insurance company will reimburse the company for any loss due to theft by employee. And number two is exactly rotating employees and requiring them to take vacations to make it difficult for an employee to commit fraud over a long period of time. And then obviously, most of you have probably undergone background checks when you were looking for a job to make sure that you know what you say on your application is true and you don't have a prior criminal record. Okay, so what are some of the limitations of internal controls? So what I just went through is all the good stuff that a company should be doing to make it difficult for employees to steal. Sometimes this is not practical in a small company. So there are limitations that include the cost of putting these controls in should exceed the benefit received from them. So sometimes for small companies, it's not practical to have two employees hired, one to do the accounting and the other to do the cash management. They just don't have the money to do that. And then there's the human element, which includes overworking your employees or collusion among two or more employees will sometimes circumvent good internal controls. So again, the size of the business is a big factor in whether or not it's practical to put in all of the controls you should have. So in the case of small companies, it might be wise to have functions that are performed by one person, accounting and cash management bonded. Get the employee bonded so you have insurance in case down the road the employee does get caught stealing from the company. All right, so that's basically what fraud and what the principles of internal control are designed to minimize the opportunities for fraud. All right, so the second part of chapter 7 was how do you apply internal controls to cash management? A cash, of course, is the most vulnerable asset subject to fraud if it's made easily available to its employees. Of course, we're talking about any type of cash, whether it's currency, blank checks, money orders, etc. And of course, you know that cash generally comes from sales over the counter. Like in a retail store, you sell something and the customer pays you in cash, or a company sells its products to another company on accounts receivable, and the company pays the accounts receivable. So collections result in cash from mail. Cash comes from receipt of interest from bank accounts, rent, and dividends, investment by owners, bank loans, proceeds from the sale of non-current assets. These are all activity that generate cash in the company. So this chart basically gives you an idea of how you can apply the internal control principles to the control over cash. So you can see that, establish a responsibility. Usually you want to designate a person to handle cash that's only authorized, or documentation procedures. Make sure that mails, receipts, or confirmation of payment is a remittent advice that's been issued. We have cash register and deposit slips. Internal verification, independent verification, segregation of duties. Different person receives cash from the person that records the cash. Physical and mechanical controls, putting the cash in the safe, using cash register and human resource controls, making sure sensitive employees that do handle cash are bonded. Okay, so that's just kind of a summary of how you can apply internal control principles to cash control. And you know that cash disbursements are the other side of cash receipts. And generally, cash disbursements are done by check these days. Rarely does companies pay vendors or employees by cash. Usually everything is now handled through a bank. And so when we're talking about cash disbursements, usually we're referring to what we refer to as a voucher system. Most companies use a voucher system, that is payment of vendors, suppliers, employees through through a checking system. And voucher system could include expense reporting document when we're talking about employees getting reimbursed for activities, and a purchase requisition document. When a company requisitions supplies from another company. And then we have the petty cash fund. So you should be familiar with what a voucher system is, how it's used, and petty cash fund. What is a voucher system? Basically, it's a way of checks and balances that make sure that checks that are issued to suppliers are properly authorized. Usually that involves, in large companies, what we refer to as delegation of authority. That is, there is a delegation that's been given to certain employees who are authorized to approve requisitions or authorized to sign checks. And usually the higher the level of the employee on the organization, the higher the level of dollars that they are authorized to approve for purchases. So a voucher document is nothing more than an authorization form, either an expense report or a purchase requisition document authorizing the use of money from the company to buy supplies or to approve travel related expenses, etc. So this is a kind of a flow diagram of how a voucher system might work. You have the employee on the left. He wants to buy something. He fills out a purchase requisition document or expense voucher, and it has certain information that needs to be included in the document, such as what is it you want to buy, how much is it going to cost, where is the charge going to be directed to, what budget center, cost center, account code, etc. And he signs it, and then he sends it to his supervisor. Supervisor has a delegation of authority to approve up to a certain limit. reviews the request, signs it, and forwards the document, if it's an expense report, to accounts payable for reimbursement processing, or if it's a purchase requisition, purchase flows it to the purchasing department. So there's expense report is generally when an employee already incurred an expense and wants to get reimbursed, fills out a expense report, sends it to the supervisor, approves it, who then forwards it to the accounting department, who pays it to the employee. Purchase requisition document approved by the supervisor goes to the purchasing department, who fulfills the order, makes the purchase, selects the vendor, etc. And then the invoice goes to the accounting department to get paid. Okay, so that's basically the flow in most companies of how a voucher system works. Do you have any questions on that?
No.
Okay, I know it seems a little complicated, but if you ever work in a company, this is what procedures they usually follow. All right, petty cash fund is another a way of dispersing funds, and it's really for small amounts of money, where a petty cash fund is set up by the company headquarters, let's say to a remote office. They send money to the remote office. Let's say you have a corporate headquarters here in Oahu, and you have a remote office in Maui. And the remote office needs to have cash, some cash to pay for small expenditures. Then they assign a person in their remote office to be responsible for the money. It's called a petty cash custodian. And it keeps the money in a safe or in a petty cash box and locks it up at night. Now, this person would basically be responsible for issuing small cash disbursements to cover things like postage stamps, maintenance expenses, small stuff that doesn't need to go through corporate headquarters every time they need to have a purchase. So you should be familiar with how the petty cash operates. There's a couple of steps. One is, first you have to establish the fund, and then 2, make payments from the fund, and then 3, replenish the fund. So you should be familiar with the procedures to do that. So for example, a company wants to establish a $100 petty cash fund. First thing that has to happen is an entry is made by the accountant to establish the fund, where $100 is released to the petty cash custodian. So this is the establishment of the fund. Petty cash custodian will keep the $100 secured in a lockbox or in a safe, and keeps a record of the ledger, keeps a ledger of all the disbursements made out of the $100, so that the petty cash fund is always equal to $100. Whether it's $50 in cash plus $50 in receipts, it has to equal $100. And then at the end of the month, or whenever the petty cash fund gets low, then the petty cash custodian prepares a petty cash report and sends it to the accounting department to get reimbursed for the amount of money that was used. So for example, let's say that during the month, $87 was used up out of the 100. That means only $13 is left in the box. So now the custodian needs to get $87 from corporate headquarters, they would have to fill out a report and send it into the accounting department to get reimbursed. So that's basically what happens. Okay, the third item is bank reconciliation. Okay, you should be familiar with a checking account in a bank and how it is used by a company. And of course, as I said, most times these days, companies don't keep much cash around internally. They have all their cash with the bank. And they pay with checks. So they minimize the amount of currency on hand. Using a checking system keeps double record of the transaction, but that requires that reconciliation of the bank account against the general ledger cash balance be performed periodically. Now, reconciling the bank account is not difficult. It just requires you to be familiar with what needs to be reconciled. When we reconcile the bank account, basically we're matching the balance on the cash balance on the general ledger at the end of the accounting period to the cash balance in the bank per the bank statement. And then to adjust the balance on the general ledger to agree with what it should be, because we always have what they call timing differences between the book balance and the bank balance, because there's activity that occurs during the accounting period that sometimes gets on the books but doesn't get onto the bank balance, or gets onto the bank balance but doesn't get onto the book balance at the end of the accounting period. And these things include deposits in transit, outstanding checks, errors, and bank memoranda. So by now you should know what those things mean. And to reconcile the bank balance against the book balance in the cash account, you need to go through a number of steps. Let's start with the bank statement. You need to adjust the bank statement for any deposits in transit. That means the company made a deposit to the bank, but it didn't get recorded in the bank balance at the end of the month. Usually this is at the last day of the month. Or there's outstanding checks. So let me clarify. The plus means you got to add any deposits that are in transit into the bank statement balance at the end of the month. Outstanding checks. Company wrote some checks to a vendor, sent it to the vendor, but the vendor didn't deposit the checks yet. So that means that the bank statement is missing those checks that were written against the bank, the book balance, the cash balance on the books. So the books on the cash balance on the books has already shown a deduction for a check written, but because the vendor didn't deposit the check, the bank balance still shows that amount in the balance. So you need to take this balance out of the bank balance to make it agree with the book balance. You follow that logic?
Yes.
Okay. And then there's bank errors that are discovered during the reconciliation that have to be adjusted either plus or minus, and do you get the correct balance? And then you do the same thing on the book side. You should add any notes that were collected by the bank that were not recorded in the books during that accounting period. You should subtract out any checks that were written by the company that bounced, and the bank took it out of the bank balance, but you didn't know about the checks that got bounced until you got the bank statement. So you need to take this out of your book balance. And then there are printing, check printing, or other service charges the bank imposed that you didn't know about until you got the bank statement. So you should, it's showing up on the bank balance, but it's not on the book balance because you didn't know about it until you got the bank statement. So you should take that out. And then there are company errors that are discovered during the bank reconciliation procedure. And then you get a correct balance and the two should equal. Okay, now, what that means is that the balance on the bank statement and the balance in the book before you do the reconciliation doesn't match. After you do the reconciliation, it matches. So that means you need to go back in and make a journal entry to adjust your book balance to whatever the bank reconciliation balance comes out to be. Then everything is in order. You have the correct cash balance reflected on the general ledger after you make the adjusting entry for the bank reconciliation. Okay, so you should know how to do that. You'll be required to do some limited reconciliation on the exam. And then the last thing is reporting of cash. Okay, cash is obviously a current asset. And usually what you'll see on a balance sheet is the term cash and cash equivalents, and also restricted cash. Cash equivalents is basically cash plus any other cash equivalents, which are defined as short-term, highly liquid investments, such as money market funds, certificates of deposit, CDs, and US Treasury bills and notes. These are, when I say highly liquid, are easily convertible into cash by the company. And if you're talking about money market funds or Treasury bills and notes, usually their maturity date is very close so that their market value is relatively insensitive to any changes in interest rates that might arise by the federal government. So interest rates go up or down, usually it affects the value of short-term, highly liquid investments. But if the maturity date is very close to the balance sheet date, then it doesn't really matter. Okay, so definition of money market funds is usually investments that are of short-term nature, usually less than 1 year, representing securities of high quality, meaning they're worth their weight in gold and can be easily sold on the market for cash. Restricted cash is money that is set aside by the company and can't be used, such as for payroll purposes or construction purposes. Okay, so that's basically highlights of chapter 7. Okay, you got it?
Yes.
Now we're going to move on to, oops, wrong one. Chapter 8. All right, chapter 8 is receivables. Okay, so this is another technical chapter, a very specific area of accounting that is very important because most companies today sell their products or services to other companies on account. That means when they sell something, they don't get cash right away. They have a future claim to get paid, and that's called a receivable. So you know from this chapter that there's 3 major types of receivables: accounts receivable, which is the focus of this chapter, These are amounts owed from the sale of goods and services. There's notes receivable, usually money that's borrowed from a bank. You'll get a note, or let me put it this way. If a company has a note receivable, that means that it is owed money from another company, usually because it loaned money to that other company, or it converted an accounts receivable to a note receivable because the period of time for a note receivable has already elapsed, and the customer requested an extension of the payment period. Usually what happens is the company will convert the account receivable into a note receivable where interest is added on during the extension period. And then we have other receivables which are non-trade related, such as loans to officers, employees, income tax refunds, etc. These are not either accounts receivable or notes receivable. These are just put into a general category called other. All right, so what is the issue with no accounts receivable? The biggest issue with accounts receivable, in other words, sale of services or products to a customer in exchange for a receivable that may extend 30 days or beyond, is what is the receivable worth on the balance sheet date that you're reporting it. And the reason why it's an issue is because some customers may not pay their accounts receivable on time, usually 30 days. After 30 days, it's past due. Okay, if it's uncollectible, we refer to that as a bad debt. That means that the company is unable to pay its debt for whatever reason. And so the issue for accounting is when you see accounts receivable on the balance sheet, in this case, you see $200,000 being reported. The question you have to ask is, if you're looking at it as the owner of the company or as an investor, is how much of that is actually going to be paid? Of course, you hope and expect all of it to be paid, but when you're running a big company with hundreds, thousands of customers, that may not always be the case. So that's why when you look at a accounts receivable balance on a balance sheet, you will see, oftentimes you will see an item called allowance for doubtful accounts, which is an adjustment to the gross receivable to show what the company thinks will be paid. In this case, even though they have receivables of $200,000, they have estimated that 12,000 of it won't be paid because of past due accounts, and therefore the net amount they think will be paid is 188,000. So this is very important, right? Because a lot of companies' balance sheet current assets are tied up in accounts receivable. You see, you notice here the cash balance is relatively small compared to the accounts receivable. Okay, so the accounts receivable is always reported as a current asset on the balance sheet. Whenever you make sales on account, there's always a possibility you won't get paid. And therefore, it's the accountant's job to determine what the company thinks will be paid or will be able to be collected. That is a very difficult process to figure out what portion of the amount your customers have promised to pay won't be paid. Okay, that's the trick. So there's two ways of trying to figure this out. One is called direct write-off method, and the other is allowance method. Now, the direct write-off method is very easy. You just write it off when you determine it's not collectible. So if you have a customer that hasn't paid in half a year, chances are you're not going to get paid. Or if you have a customer that has declared bankruptcy, chances are you're not going to get paid some of it or all of it. So at some point in time, you have to make a decision to just forget about it. That's called the direct write-off method. So you charge it as an expense, get it out of the accounts receivable balance when you make that decision. This approach is theoretically not desirable because it doesn't match the revenue from the sale with the bad debt expense entry if you record it in two different accounting periods. So you could record a sale in 1 year and then wait till the following year to make a bad debt entry, but you have 1 year overstated revenues and the other year overstated expenses. So there's no matching. And your receivables are not stated at net realizable value on the balance sheet date. This is not acceptable from a financial reporting or generally accepted accounting principle standpoint. Okay, so quick example, the company owes 520, company determines it can't collect it, they're just going to write it off, charge bad debt expense 520, credit the receivable 520. That's it. That's how you do it. All right, the allowance method is the more complicated method. Now you have to make an estimate of what you think is not going to be collectible in the future. And there's a better matching of revenue with the sales when you do this method. When the receivables are now reported at net realizable value. This is required by generally accepted accounting principle. Okay, so here's an example of how you might do this. The credit sale 300,000, end of the year, 20,000 of credit sales is uncollected. In other words, they've collected 280,000 of the 300,000 that was sold during the year, and there's 20,000 still unpaid. Based on experience, they estimate that 1,500 of the 20,000 will go back. So to book this, they're going to make an entry to debit bad debt expense 1,500 and set up an allowance for 1,500. All right, so this is basically the allowance method. You credit the allowance account. You don't credit the receivable account because you haven't written off the account yet. You're only estimating it's going to go bad. So the receivable account is still reported at 20,000. The allowance for doubtful account has now been established for 1,500 credit. How do you present this on the books? You show receivable at 20 and allowance at 1,500, so your net receivable is 18,500. So this allowance is what we consider as a contra asset. And your net realizable value is 18,500. Now, what happens if you do this and you decide you want to write off part of it, let's say 520. So the entry to write off an allowance you already set up, instead of debiting or crediting accounts receivable, you're going to instead of debiting the receivable account, you're going to debit the allowance for doubtful account and credit the receivable. Let me backtrack. Instead of debiting the bad debt expense account that you would have done under the write-off method, you're gonna debit the allowance for doubtful accounts, because when you set up the allowance for doubtful accounts, you actually did do a debit to the bad debt expense right here. So you don't have to debit bad debt expense anymore. You're gonna debit the allowance account because you had the allowance set up. And then you're gonna credit receivable, and it's just gonna adjust your receivable balance down. So what happens is, when you make this entry, you'll see that the accounts receivable is at 20,000, and you make the entry to write off 520. You're gonna debit the receivable. I'm sorry, you're gonna debit the allowance account for 520 and credit the receivable for 520. So here's the allowance account, debit against the 1,500 credit, and there's receivable account, credit against the 20,000 debit balance there. So notice what happens is that the balance sitting in the net accounts receivable is still going to report as 18.5. Before the write-off, we had 20 gross and 1,500 allowance, 18.5 net. After the write-off, we adjusted down the receivable by 520, and we adjusted the allowance by 520, and the net is still 18.5. So it doesn't affect the net realizable value. Okay, so that's basically the concept behind the allowance method. Okay, there's two ways of estimating bad debt: percent of sales and accounts receivable method. Under accounts receivable, you have percent of receivables and aging of accounts receivable. Are you familiar with these two accounts receivable methods?
Yes.
Okay, do you want me to go through it or not?
Yes.
Okay,
Or no.
well, up to you, you know. Yes or no?
Yes.
Okay, percent of sales. Very simple. Take your sales for the current period and apply a bad debt percentage. That would give you your estimated bad debt expense. Where does the bad debt percentage come from? Example, company had $400,000 in sales. Historically, that's where it comes from. Historically, experience. As I guess that's 0.6% of 1% credit sales goes bad. Bad debt expense is basically apply your bad debt percentage to your credit sales to come with an estimated bad debt expense of 2,400 and make an entry to debit bad debt expense and credit allowance for doubtful accounts. So that's pretty black and white. It's the percent of sales method, but you need to know what is your historical run rate. Now, normally when you're solving a problem, this will be given to you. The other method is the percent receivable method, where you take your balance in the receivable account and you apply bad debt percentage. So unlike the sales method, where you multiply the percent against the sales, you're going to multiply a percent against the receivable balance off the balance sheet. So bad debt expense is computed as the total estimated bad debt expense minus the previous balance in the allowance account gives you your current bad debt expense. Okay, let's walk through that. Company had $50,000 in receivables. Has a $200 credit still sitting in the allowance for doubtful account. Remember, this balance sitting in the allowance account is only an estimate. At the end of the year, you'll always have something left in there. Could be a debit balance, could be a credit balance, depending on how accurate your estimate was. Okay, so they have still $200 of unused credits. Past experience suggests 5% of receivables are uncollectible. So to compute the desired balance in the allowance account, you multiply the 50,000 balance in receivable times the 5%, which is normally given, to get the amount that should be in the allowance account. And since there's still 200 sitting as a credit in the allowance account, and you want the balance now to be 2,500, you only need 2,300 to bring up the balance in the allowance account to 2,500. So since there's still 200 that was unused at the end of the year. Okay, you follow that?
Yes.
So then all you need to do is make an entry to debit bad debt expense for 2,300 and credit allowance for 2,300. All right, so that's one way of doing the receivable method. The other method is the aging method, where you go through and you look at all of your receivables and classify it by age groups. And of course, the older the receivable, the higher the probability it won't be collectible. So you classify it by age group and you develop a bad debt percentage for each age group. The younger the age group, the lower the percentage uncollectible. The higher the age group, the higher the percentage uncollectible. So you can see from this chart, we've done an aging analysis of all the customers in the accounts receivable ledger by age groups. Not yet due is within 30 days. 1 to 30 days past due means it's past due. That means we're in day 31 to day 60. Because anything that's not yet due is still within the 30-day allowance period granted to most customers. If it's 31 to 60 days past due, that means that it's 61 to 90 days from the date the invoice was issued. If it's over 90 days past due, that means it's 120 days from the date of the invoice. You follow that? Or did you, did it make sense?
Yes.
Okay, so you get the amounts stratified by age groups. Here's the total receivable, 50,000, broken down by age groups. And then you apply a percentage uncollectible to each age group. So you notice that the ones that are fresh, past 30 days, but less than 60 is 2%, but the ones over 120 days is 40%. So that means that based on their experience, it's a much higher probability that they won't be able to collect 40% of the ones that are over 90 days past due. Multiply it against the percentage and come up with the total amount for each group. And the total is 2,270. And then all you do is make your adjusting entry based on the 2,270. And since we still have 200 sitting in the allowance account, then we only need to book 2,070 to bring it up to 2,270. So that's the other way of doing it. Okay, so that's how bad debt expense is estimated under the allowance method. And the last thing on chapter 8 is the turnover ratio. So one of the important statistics is management uses is just to kind of keep track of how effective their collection procedures are is to compute the turnover ratio in accounts receivable. So basically, it's used to assess liquidity of receivables and measure the number of times on average a company collects its receivables during the period. And it's very simple. Take your net credit sales divided by your average net accounts receivable balance equals your turnover. So if your net credit sales is 29,462 and your average balance sitting in your accounts receivable at the beginning of the period and the end of the period divided by 2, added together, gives you a turnover ratio of 8 times. That means you're turning over your receivables, collecting your receivable on average 8 times during the accounting period or during the year. Is that good or is that bad? Well, normally, if you have a high turnover, that's better than having a low turnover. That means you're collecting your receivables faster. A variant of the turnover is average collection period. So this tells you how many days it takes to normally collect a receivable. So if we take the number of days in the year divided by the receivable turnover ratio, you get the average collection period. So if there's 365 days divided by 8, that means that the average number of days it takes to collect is 45 days. Now, is that a good number or is that a bad number? Well, it depends. If your collection policies is you give the customers 30 days on average to pay their bill, and your average collection period in days is 45 days, that means you're not meeting your 30-day requirement. On the other hand, if your collection policy is to give customers 50 days and you're collecting in 45 days, it's okay. So I would say that if your normal policy is to give customers 30 days to pay and you're averaging 45 days, then their collection efficiency is not good. You need to do something to improve the collection turnover. All right, so that's chapter 8. Any questions?
No.
Is it, you had enough?
Can we go over chapter 9?
Yeah, I'm going to do that now. Now, chapter 9 is a totally different topic, plant accounting. Now, this gets even more technical, as you probably know by now.
Mhm.
Wait a minute, what happened here? Okay, so in chapter 9, we're going to talk about plant accounting and depreciation mainly. So you know that plant is an asset on the balance sheet. It's not a current asset, it's a long-term asset. And the definition of plant is it's something you can touch. It's used in operations. It's going to provide benefits in the future. And we call it property, plant, and equipment. Okay, wait a second. I have an issue here. I got to figure out what's happening here. I'm going to stop the share, okay?
Okay.
We'll see what's going on with this slide here. Why does it do that? Okay, there's animations. Ooh. You know, are you familiar with PowerPoint?
Yes.
I'm gonna try to figure out how to turn off this. It seems to be on automatic advance. I can't remember what the slideshow. Maybe it's in the slideshow. Play narrations. Use timing. Let me try it now. Okay, I got it. I had to turn off something. Okay, we're back. So jumping on to the next slide. What are the rules regarding property, plant, and equipment? Again, it must be long useful life. For example, a car or machinery or a building, they have long life. They have to be used in operations to qualify as property, plant, equipment. And because they have long life, we can't just charge it all off the expense in the period it was acquired. We have to spread out the cost of the asset to expense over its useful life. We call that depreciation. And we have a new term called accumulated depreciation, which is basically the amount of or portion of the plant cost that was charged off to expense up to the point of balance sheet reporting, or the accumulated expense called accumulated depreciation. So you know that a long life asset has 3 phases in its life. The first phase is when you buy it, and that's when you have to be able to compute the cost. The second phase is when you use it. That is when you have to figure out how to allocate the cost in the acquisition computer under the acquisition over its useful life. And the final phase is when you no longer use it, you have to replace it. That's called disposal. How do we record the disposal? Now, this is a very important topic in accounting because most companies have assets, long life assets, and they need to make sure they're accounting for their long life assets in a proper way to properly report the expense of that asset to each accounting period throughout its useful life. Because if you don't do it right, you're going to end up distorting your expenses, which will distort your net income or net loss. So first phase, acquisition costs. Just remember that when you buy assets, you can include land improvements, buildings, equipment. These are all considered plant assets, sometimes called fixed assets, property, plant, equipment, or plant and equipment. These terms mean the same thing. How do you determine what a plant costs? Well, it's very easy. It's what you pay for it. If you're buying, let's say, if you're buying a tractor, you pay the seller an amount of money. That's the acquisition cost. That's what we call the purchase price. But you also need to include any expenditures that were incurred to get the asset ready for its intended use. And this could even include financing charges. Prior to getting the asset ready for its intended use. Now, what I mean by that is if you're constructing a building and you go take a loan from a bank and it takes 2 years to build the building, then the interest that you're paying on the loan for those first 2 years can be considered as part of the acquisition cost. After that, it's no longer part of the acquisition cost. It's just interest cost. Okay, so breaking down plant assets, land is considered a plant asset. Normally, when you buy land, you have to incur certain incidental expenses. These are before you put the land in service. These are considered like surveying fees, real estate commission, title search. These are expenses incurred to buy the land. Those are included in part of the cost of land. Land improvements are different from the acquisition of land in that you're spending money to get the land ready for its intended use. These are considered land improvements. So there's another account you should record that in, such as parking lots, building a fence, driveways, landscaping. Buildings is pretty cut and dry. It's either you buy the building already built or you build it. So if you're building it, it's the cost of construction. If you're buying it, it's the cost of purchase. And again, like land, you're going to have some certain other costs that you might have to incur to get the building. You should throw that in as part of the cost of the building on the balance sheet. Don't charge it to expense, charge it to the cost of the building. Machinery equipment, same thing. What do you pay for it? If you have to install, assemble, and test the equipment before you put it in service, you should include that as part of the cost of the machinery and equipment. Taxes, transportation charges, insurance, any incidental should be included in the account machinery equipment. Okay. Next, after you get the equipment and it's put into service, then you got to spread the cost over its useful life. That's called depreciation. Because usually what happens is an asset value will decline over its useful life. So it's like if you buy a car today, you pay $30,000 for a car today and use it for the next 5 years. It's not going to be worth $30,000 at the end of 5 years. It's going to be worth maybe nothing or some small amount called salvage value you can sell it for. So we need to take the 30,000 in this example and spread it out to expense, let's say over 5 years, if it's a car. How do you do that? It's called depreciation. What is it? It's allocating the cost of the plant asset to expense in the accounting periods benefiting from its use. So we're going to move the cost that was recorded on the balance sheet over to the income statement as expense through the process of depreciation. So depreciation is basically allocating the cost of a tangible asset in a systematic and rational manner to future periods. It's a process of cost allocation. It has nothing to do with what the value of the asset is worth at any given point in time. Everything is depreciated except land. When it comes to land, we don't need to do this. Just leave it on the books at original cost. Don't depreciate land. All right, so what do you need to know to compute depreciation? You need to know what the cost is. And you need to know how long you're going to use it. And then you need to know what it's worth at the end of the useful period, useful life. That's called salvage value. So you need to know these three components. There are several ways to compute depreciation. Straight line, units of activity, declining balance. All are acceptable for generally accepted accounting purposes. The objective is to select the method that best measures the contribution of the asset to the revenue it helps generate over its useful life. In most cases, most companies use straight line method. Why? Because it's the simplest method to use. Here, example, an item costs $13,000, let's say a truck. Salvage value is estimated at $1,000. Life, 5 years. 5 years is the same as a 20% depreciation rate, because if you take 1 year out of the 5 years, that's equal to 20%. And the estimated useful miles is 100,000 miles over 5 years. So if you compute depreciation using these three methods, let's start with straight line. Same amount every year. How do you compute it? Depreciable cost is original cost minus salvage. In this case, depreciable cost is the 13,000. Let me go back. Take your depreciable cost divided by useful life, get your annual depreciation expense. In this case, the cost is 13. The salvage is 1,000. The life is 5. You take the 13, take out the salvage, get 12 divided by 5, get 2,400 is your annual depreciation expense. So every year for the next 5 years, you're going to book $2,400 depreciation expense and credit accumulated depreciation $2,400. The book value of this asset at the end of the first year is the original cost minus the accumulated depreciation, $10,600. When you hear the term book value, that means original cost minus accumulated depreciation. You're going to do this for the next 5 years. Same entry. Book value will go down. At the end of 5 years, your book value should equal the salvage value, because you took that out in the beginning when you computed your annual depreciation expense. You follow that?
Yes.
Okay, units of activity. In this case, you compute a depreciation rate per unit, in this case, miles. So your depreciation expense is going to vary depending on how many units are used up during the year. So let's assume 15,000 miles the truck was used for first year. To compute the depreciation, you take the depreciable cost divided by the total units of activity equals your per unit rate. And then you multiply that times your activity during the year to get your annual depreciation expense. In this case, your depreciable cost is the same as the straight line, original cost minus salvage, 12,000. The total estimated miles that you're going to expect from the truck is 100,000. Divide 12,000 by 100,000 to get the rate of 12 cents per mile. Multiply that times the first year miles of 15,000, and you get $1,800 as depreciation expense. Entry debit depreciation expense, 1,800. Credit accumulated depreciation expense, 1,800. Okay, and you can see the same methodology. Book value is 11,200. The following year, 30,000 miles is driven on the truck. Depreciation is higher. Book value goes down, and you do this every year. And if everything is correctly done, and the estimate of 100,000 miles is correct, you should come out with a book value at the end of 5 years equal to the salvage value. Now, the reason why this is not popular is because it requires the company to keep track of all the miles that was used by the truck. So a lot of companies don't want to do all this extra bookkeeping, but some companies will. All right, the last method, declining balance. So this method charges more of the cost of the asset over its early life than in its later life. And the reason for this is because usually an asset costs more to maintain at the end of its life than in the beginning of its life. If you take a car with a 5-year life, you know that in the first 2 years, you probably don't have to spend much money to keep it up. But in the last 2 years, you're going to have to spend money, such as replacing the tires and doing other repair work on the car. That's why we have this declining method to charge more of the cost of the asset in the beginning to compensate for the fact you're going to have to spend more money in the end just to maintain it. The declining balance rate is normally double the straight line rate. The only catch on this method is the depreciable cost is not the original cost minus the salvage. Depreciable cost is the book value, or what we define original cost minus accumulated depreciation. We don't care about the salvage value. We don't include salvage value in the calculation. So it's the beginning book value times the declining balance rate equals the annual depreciation expense. So what is the declining balance rate? Normally it's double the straight line rate. So if you have a 5-year life asset, which has a 20% straight line rate, then the declining balance rate will be double that. So in this case, the straight line rate was 20%. The declining balance is going to be 40%. So we're going to charge off 5,200 to depreciation expense. Now the declining balance rate could be double the rate. That's a 200% rate, or it could be 150%, or it could be 125%. But for the sake of simplicity, we're just going to assume a 200% rate or double rate. Now, when you get a problem in the exam, it might tell you double declining balance, or it might say 150% declining balance. If it's 150%, then don't use 200%, use 150%. So here's how the declining balance rate would look on the chart. As you can see, the book value declines at a faster rate using declining balance. And you can see that the annual depreciation expense on the second year is based on the book value at the end of the first year times the double declining balance rate. So the annual expense is going to drop each year. It's smaller and smaller. When you get to the final year, notice that the annual expense is 685. Now, where did this number come from? This number is a plug number because we want the book value at the end of the final year to be 1,000, equal to the salvage value. If you multiply 1685 times 40%, you're not going to get 685, you're going to get 674. So we need to plug that number so that when you subtract out 685 from your book value at the end of the fourth year, you come back to $1,000. If you just applied 40% to this number, you get 674, and you won't come to 1,000. You come a little bit over 1,000. You follow that?
Yes.
Okay. So that's the trick about declining balance rate. All right. How do you dispose of plant assets when they're finally no longer useful? Okay, there's three ways to dispose of plant asset: retirement, sale, or exchange. When you retire an asset, you're basically getting rid of it, scrapping it. You don't get no money for it, you just give it away, or you junk it. When you sell an asset, you're selling it either at below or above book value. You're going to either make a profit or make a loss. That is because you're getting something in return for it, cash. And when you exchange something for another like asset, you're also going to end up making money or losing money. For this purpose, we're not going to hold you responsible for exchanges. So you don't have to worry about how to compute an exchange, just how do you do a retirement and how you do a sale. So an exchange could involve giving up the old equipment. Let's say you have a car, you want to trade in for a new car. You have to give up your old car, the company will give you a trade-in value, and then you have to pay the difference in cash. Okay. So how do you compute a retirement or a sale? First, always update depreciation expense up to the date of disposal. Journalize the disposal by recording the cash received, removing the accumulated depreciation balance by debiting that account, removing the asset value by crediting that account, and then there's a number that will make everything balance, either a credit or debit number. If it's a credit number, you made a gain. If it's a debit number, you made a loss. When you record a gain or loss, it will be determined whether the cash you received is larger than the book value. If you got more money than what the book value of the asset is worth, then that you made a profit. You record a gain. That will become a credit entry. If you got less money, cash, than what the book value on the books is, you'll have a loss. That means you have a debit entry. If the cash you get is exactly equal to the book value, then you have no gain or loss. So let's go through the procedure. Update depreciation to date of disposal, debit depreciation expense, compute the depreciation expense up to the date you're getting rid of the asset, credit the accumulated depreciation, remove the old asset from the books, zero out the asset by crediting the original costs on the books, and then zero out the accumulated depreciation by debiting the balance in that account. And then record any cash received, and then determine whether there's a gain or loss. So I'll go through a simple example. The company has some printers, $32,000. It fully depreciated the printers. It's retiring the printers. It's not selling it, it's retiring it, it's throwing them away. On the books, the printing equipment has a balance of $32,000 original cost and accumulated depreciation, $32,000. To retire this asset, all you got to do is debit depreciation accumulated, credit equipment, 32,000, and it's off the books. Now, what happens if the fully depreciated plant asset is still used for the company? Okay, let's suppose they don't retire the asset, but it's fully depreciated. They can still use the asset, but they can't make any more entries to debit depreciation expense. You cannot charge to expense more than what you paid for the asset. Now, what happens if they decide to get rid of this equipment, delivery equipment that costs 18,000, but they only charge off 14,000 to depreciation expense? In other words, they only have accumulated depreciation of 14,000. If they decide to prematurely dispose of the asset, they're going to incur a loss. That loss is going to equal $4,000. The difference between what they paid and what the accumulated depreciation is. Because when they book it, they're going to have to remove the accumulated depreciation, remove the equipment, zero it out, and book the difference to loss account equal to $4,000. Otherwise, the debits won't equal the credits. Okay, you follow that?
Yes.
And you will report this loss on other expenses and loss on the income statement. What happens if you sell a plant? Again, compare book value of the asset with the cash received. If book value was equal to the original cost minus accumulated depreciation, if the cash received is greater than the book value, you got a gain. If the cash received is less than the book value, you have a loss. Let's suppose that this company sells some furniture for 16,000 cash. Originally cost 60,000. It had accumulated depreciation of 41. And then the depreciation for the first 6 months of 2010, 8,000. This is the entry necessary to bring the depreciation expense up to the date of the sale of July 1st. So they got to record this entry to debit expense 6,000, credit accumulated depreciation. So now your accumulated depreciation after this entry is 49. The 41 at January 1 plus the 8,000 for the first 6 months of the year. So to compute the gain and loss, you take the cost of the furniture, minus out the accumulated depreciation, book value asset 11, sold it for 16. They sold it for more than the book value, they have a gain of 5. How do you record this? Debit the cash account for the amount received, clear out the accumulated depreciation, 49,000, clear out the office equipment balance of 60, and debits don't equal the credits. Now you got to record additional credit of 5,000. That's the gain. That's the profit they made on the sale. This is reported as other revenue gain on the income statement. Okay, that's kind of a simple example of how this was computed. So now we have gone through the 3 phases of plant accounting: acquisition, use, and disposal. Okay, the 4th and the 5th topics are natural resources and tangible assets. And I'm going to quickly go through this. Natural resources are things that are taken from the ground, like trees and oil, gas, and minerals, and can only be replaced by acts of nature. Okay, so when you use up natural resources, you use the term depletion instead of depreciation. And depletion is like unit accounting and depreciation. You have to figure out how to deplete the natural resources units consumed. So we use the units of activity method. Okay, so simple example, if you have a coal mine and it costs $5 million to buy the coal mine, and it's expected to generate 10 million tons of coal, then your depletion rate is 50 cents a ton. If you first year you took out 800,000 tons of coal, then the charge to expense is $400,000. 50 cents times 800,000 tons. Okay, that's kind of how you work that one out. And you would present your natural resource similar to your plant assets, but it's not plant assets, it's natural resources. You would list, in this case, coal mine, original cost 5 million and accumulated depreciation 400,000, net book value 4.6 million. Okay, you know what? I think that's enough for now. I think that is the gist of what you need to know for the chapter 9. Yeah.
Yeah.
So, do you have any questions?
Yeah, I had a question about how do you find like the fraction for the year?
For what are you talking about? Depreciation or accounts receivable?
Like the calculations, and then they say like January 2022 to like a couple years later, and then a month like October 2025.
Okay, just a minute. I think you're talking about depreciation, right?
Yes.
Okay, let me, I don't know if you're talking about this slide or the declining balance.
Well, one of your Ed Puzzle questions, one of the examples is the Concord Company purchased a machine on January 1st, 2016 for $53,000 with an estimated salvage value of $12,000 and an estimated useful life of 8 years. On January 1st, 2018, Concord decides the machine will last 12 years from the date of purchase.
Oh, okay. I got you. Somebody asked me that before, yeah. Okay, I understand what you're talking about. Partial year or a change in depreciation estimate. Let's go back to that one.
I'm kind of confused on how to find like the fraction.
I'll explain that to you. Okay, first I'm going to show you how it's done, and I'll go through that problem with you, okay?
Okay.
Okay, so quite often, not very often, but sometimes, when a company estimates its useful life, it's an estimate. And oftentimes, the estimate has to be changed because new information results in them extending the life or shortening the life of the asset. So whenever there's a change in the life of the asset during its use, we have to change the future estimate. We can't go back and change what we already recorded. This isn't considered an error. It's not considered an error. It's considered a change in the estimate. So we never go backwards. We always go forward. So here's a example of how that works. Let's suppose that the company decides to extend the useful life of a truck by additional 1 year because it's in excellent condition. What is the journal entry to correct the prior year's depreciation? In this case, none. How do you calculate the depreciation expense going forward? Okay. So let's suppose that on January 1, the book value was this is the straight line method, yeah? On the truck example we went through. So this was the example where the truck was purchased for 13, salvage 1,000, had a 5-year estimated life. At the end of the 3rd year, the book value is 5,800. At the beginning of the 4th year, they decide that the truck is in excellent condition. It should give us 6 years instead of 5 years of service. We need to revise the depreciation rate at the beginning of the 4th year. So what we're going to do is we're going to take the book value at the end of the 3rd year, take out the salvage value, which hasn't changed. That gives us a depreciable cost of 4,800 and divided by its revised useful life, which is 3 years, right? You know where the 3 years came from?
The previous years?
No, remember? Yeah, remember it was originally 5 years, right? We already booked 3 years. We already booked 3 years, right? So under the original 5 year, there's only 2 years left. But they now estimate an additional 1 year.
Oh, yeah.
Now they got 5, now we got 3 years. So we're gonna take that over 3 years. The book value over 3 years instead of 2 years under the original 5-year plan. That gives us a new rate of depreciation charge of 1,600. So we're gonna make a journal entry for 1,600. Okay, you follow that?
Yes.
You got that, right?
Yes.
Okay. 1 second. I gotta go to my other okay, you see the note I have here that I sent to another student?
Yes.
Okay, so this is a problem, right? you said the original machine has an 8-year life, right?
Yes,
Original cost was 53,000.
yes.
Salvage 12.
53.
Sorry,
73,000 or 53,000?
what does your problem say?
53.
Yeah, that's what I have here, right? 12,000 salvage.
Yes.
Okay, so if you take the 53 original cost, take out the salvage of 12, it was 41,000 depreciable base divided by the 8-year life. The annual depreciation was 5125 under the original assumption, correct?
Correct.
So this is, the promise is at the end of the second year, accumulated depreciation is 10,250. So we're going to revise the depreciation rate. This says the revised life is now increased to 12 years from the date of purchase. Is that right?
Yes.
Okay, how many years have we already depreciated under this problem? Out of the total 8 that was originally estimated, how many years have already passed?
2 years?
Yeah. So under the original plan, if we were to stick to the 8-year, there would be only 6 years remaining, right?
Yes.
Under the new plan, if it now is 12 years and we already took away 2, then that means there's 10 years left. Right?
Yes.
All right, so now we have the numbers to compute the new depreciation amount. So how do we figure that out? Take the original cost, subtract out the accumulated depreciation at the end of the first 2 years, which is the 5,125 times 2 or 10,250. Got that?
Yes.
Okay, and then you take out the salvage value of 12, which hasn't changed. That gives you a new revised depreciation base of 3,750. You got that?
Yes.
Then you're going to spread that over 10 years. Now, what is the 10-year life rate? If you're saying it's 10 years and you divide 3,750 by 10 years, that means every year you should charge up 30,775 to depreciation expense, correct?
Yes.
But your question is, how do you calculate the new depreciation rate? What is the 10-year depreciation rate?
Is it the 3,075?
No, rate means percentage. What is 1 divided by 10?
0.1?
0.1 is 10%, right?
Yes.
See down here?
Yes.
If you take the 30,750 new base, depreciation base times 10%, that will give you your annual depreciation expense of 3,075.
Okay.
That's the same as taking 3,750 dividing it by 10 years. You get 3,775.
Oh, okay, that makes more sense.
So this is an example of depreciation revised estimate.
Okay. Thank you.
Was that good for you?
Yes.
Okay, so we're going to end the session now then, right?
Yes. Thank you.
Okay, all right, good luck.
Thank you. Bye.
Bye.